Today, a further update on mortgage loan approvals. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I've been watching the House Economics Committee discuss banking with the CEO of ANZ and the CEO of NAB. It's quite an interesting session, actually. Quite a few things came up. And of all the things that was discussed, this section is perhaps the most significant for me.
Can you perhaps outline one of the things that's been raised with me, and we discussed this morning, particularly around ASIC's tougher enforcement of responsible lending laws?
Yes.
What impact is that having on credit flowing to borrowers?
It's slowing the process down. I've been meeting with some of our frontline bankers over recent weeks. We believe that in aggregate, most borrowers who previously would have qualified for a home loan will continue to qualify for a home loan. However, the documentary requirements that are now being asked of our frontline bankers are such that it slows the process down. And as a result, we are lending less in home lending than we might otherwise be able to. Much of that relates to household expenditure verification. I think that would be the answer you've probably received from other banks as well. Income verification.
Not many have been very specific, to be frank. So
sorry.
Not many of them have been very specific.
No, well, the income verification has not materially changed. We were already verifying income on customers. The issue has been to what extent we make reasonable inquiry into the expenditure information of households applying for home loans.
One of the main bits of feedback that I think I've received as a Member of Parliament, I imagine others, is the granularity now.
Correct.
And the detail that I now need to identify how much I'm spending on just about every single thing. Would that be a fair summation of what you're suggesting?
That's my understanding of where the issues have arisen, yes.
Okay, so
Tim, it's around about 12 or 13 categories, and just a couple of data points to support what Phil was saying. So in terms of approval rates that we're seeing currently, they're actually consistent with what we were seeing last year. So that's where we have an application, and the proportion of those applications we actually approve, it's a similar trend, which indicates that whilst the process is undoubtedly more difficult going through the 13 categories, that the actual approval rates are very similar.
Okay,
What's the driver actually, which you may have been made aware of previously, is applications are down though. And it's thinking about, well, what is the driver being, applications being down, and that's clearly, broader factors potentially, as well as the difficulty in getting all the information together can play a role as well.
So as you heard, Phil Chronican, the new NAB CEO, made the point that currently the volume of new loan applications for mortgages is significantly down, but that the proportion which are approved by the bank has remained roughly the same as it's always been. Now, it's worth asking the question about why applications are down. And clearly part of it is the need now to provide significantly more information before the application is processed, the 13 categories of expenditure, for example. We know that many households find it very difficult to accumulate the data required to be able to provide the information that's now required. But I think there's another question to ask, and that is, why are people less likely to want a loan now? And that goes back to my survey data from a couple of weeks ago. We discussed that in a separate post. But essentially, the news is that less people are considering buying property. Maybe not surprising, because prices are falling. And whilst the real estate sector is saying it's a great time to buy, it's a buyer's market, the fact is prices are likely to fall further. And many people are now realising that it's better to wait. And in fact, there was an article today in the AFR which covered this from the perspective of first-time buyers. We were quoted in the article. The point is, demand for new property is coming off. And that's simply because property prices are falling, not rising. property investors are not convinced about the economic proposition of buying property at the moment. And whilst down traders who are trying to sell and get out and release equity are still very active, property investors, first-time buyers, and even those seeking to trade up are all standing on the sidelines. And I think we have to therefore recognise that the lack of demand is what the banks are seeing. And the tighter lending standards that are now in play is part of the story. But the broader perspective, specifically relating to should I buy and should I buy now, is the real story here. And because of the results of our surveys, we continue to expect home prices to slide further in the weeks and months ahead, supply and demand, etc., etc. And of course, the fact of the matter is that still, at the end of the day, when you apply for that loan, you'll probably apply for a smaller loan, and the bank will probably want to give you a smaller loan. ANZ said 20% compared with 2 or 3 years ago. Other banks have reduced their loan-to-income limits. And so therefore, not only is the size of the loan smaller, but you've got lower demand to start with. And yet the banks can still say our approval ratings are the same as they always were. So as always, it's worth standing back and looking at the big picture rather than taking one particular piece of information out of context. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.